So the much awaited budget 2025 has been unveiled by the finance minister, and as it was expected and already announced earlier that a new tax code is already under the process. The finance minister has confirmed that the process is almost complete, and within a week's time we should expect the draft bill, which would be there for public comments. So one of the key principles that the FM has been emphasizing is on the concept of trust first and scrutiny later. She also emphasized on the Nyay Samvidhan. So the emphasis of the Indian authorities is moving more on trusting the taxpayers and inviting more and more offshore players to Indian market, and making doing business more easier and easier. That's what the intention is. However, as we had seen a little bit in the past in 2010, when the direct tax code was published, we'll have to wait for the fine prints in the next week and see how the actual code or the bill is going to be, because as always the devil is in the detail, and the Indian tax regime it's very wide and trying to capture so many areas. It is always expected that some kind of interpretational issues will always be there. So the ultimate purpose of reduced tax litigation we'll have to see in the fine prints. So while we wait for the finance bill which is going to replace the Income Tax Act, the current budget has also proposed various amendments for which would be applicable for the current year. So for the year coming April 25-26, all these amendments would be applicable. So this brings us also to one analogy that the new bill that they are likely to publish next week should more likely be effective from the next financial year, that is beginning financial year beginning 1st April 2026, and hopefully that gives the time window to everyone to prepare, understand, provide their comments, and ultimately have agreed bill that would be available to everyone. Just quickly taking you through the current proposals which would be effective from by and large from 1st April 2025. FM has largely offered the amendments in two parts. You can put it in two buckets. One you can say of which are more towards ease of doing business, and the other is more towards promotion of investments. Now when it comes to ease of doing business, a couple of things that has been done, especially I would start from some of it for the non-residents. As we have seen, like there have been so many major non-resident players who have been investing in India, and especially into electronic and manufacturing segment in fields like semiconductor. And one of the key requirements for them is the support infrastructure, which as of now may not be available in India, and a lot of non-resident companies are required to give them these services. In order to boost this segment, the law has now offered that any non-resident who would come and provide these services to the specific electronic manufacturing sector, they would be available, they can avail a presumptive tax regime. So whereby only 25% of their gross income or gross receipt would be regarded as taxable receipt, and effectively their tax would be somewhere in the range of 10 to 11%. So this is again a very win-win situation in order to boost the entire electronic and manufacturing, especially the semiconductor manufacturing boost in India, that will indirectly support so many various industries like computers, electric cars, and so many segments. So it's a very, very important step that has been taken by the government. So a couple of other changes related to the ease of doing business, again for non-resident, has been a clarification in the concept of significant economic presence. So if a non-resident had set up or acquired any goods and they were stored in India, then pursuant to the past amendments, there was ambiguity whether that would be regarded as a significant economic presence in India and would lead to taxation for such non-residents in India. Now this has been clarified that if a non-resident is storing any goods in India and mainly for the purpose of export of such goods, then it would not be regarded as a significant economic presence in India. So this would again provide more and more clarity to such non-residents to buy goods from India and enhance the export industry from an Indian perspective. One another aspect which usually used to hanger around for non-resident taxpayers used to be the transfer pricing assessments. So typically, as India follows a particular financial year and an assessment year, similarly the tax assessment that used to happen by the tax authorities would be for each separate financial year. Now, typically these investments or any international transactions, that would be same and that would recur every year. However, as a matter of process, these assessments used to happen for each year separately, and hence there used to be a lot of replication and duplication of work. Recognizing these issues, the tax authorities have now suggested that for transfer pricing assessment, one can undertake a block assessment. So there will be only one assessment for a period of 3 years if the facts of the transaction are same and similar in nature. So this would reduce the efforts spent by the taxpayers as well as the tax authorities and simplify the ease of the doing in India. Similarly, just to very quickly take from an ease of doing business from an indirect tax perspective as well, for most of the imports, there used to be various tariff rates under the customs regime. Now, in order to simplify, and there used to be always a dispute with the tax department vis-a-vis the classification of these goods. Because there are so many different tariff rates, it is possible that the interpretation of the taxpayer of classification would be different as against the government. Now, in order to bridge this gap, these tariff rates are now being narrowed down, and as of now, they have eliminated 7 different tariffs which used to be there earlier. So this is again a very positive move, and this would reduce disputes related to customs and the goods classification from this aspects. Coming on to the another bucket which I mentioned, one was ease of doing business and the other promoting investments. Now, various incentives were already there on the Indian statute, and a couple of them were looking at the sunset in March 2025. Now, in order to make sure that the Indian growth and the GDP is on the right track, so most of these incentives have been given an extended life of another 5 years. Mainly, we can look at the startup. So, for any startup, in order to avail, there is a tax concession provided for a period of 3 years out of the first 10 years, which a startup would avail. However, one of the key conditions was that the startup should be operational by 31st March 2025. Now, this has been extended by another 5 years. Again, a very welcoming move, especially the number of startups that India is looking at and the number of the type of investments that is happening into these startups. Extension of 5 years at one go, I think that's a very, very welcoming move, and we will this will promote a lot of innovations and promote new age investments into this sector. Similarly, sovereign wealth funds, they were also looking at a sunset period on March 25. Now that has also been extended by another 5 years. Another area which mostly we see some reliefs every year has again been looked upon by the Indian government, which is the GIFT City. In order to make sure that GIFT City is promoted well and it reaches the desired output, there have been various amendments again provided this year, mainly focusing on shipping business and insurance as well. Similarly, for any entity, there has also been an extension of the date on which the entity needs to be in operational to avail the tax benefits in a GIFT City. Hence, again, it's a welcome move. So all eyes towards foreign players coming and setting up their offices or units in the GIFT City. Lastly, while there are various other minor amendments related to, there have been even amendments related to carry forward of losses in case of an amalgamation. These are more of a corrective, like earlier the pursuant to a merger, the carry forward of losses would get a fresh life of 8 years. Now there are some amendments to restrict these time period and to make sure that the benefit is available only for an overall period of 8 years. And something similar, there are various other small provisions to that. So while there are various other small provisions, one small amendment which may have a major impact, especially for our crypto clients, is there is an amendment which requires, which enables the tax office to classify or notify a class of taxpayers who would be regarded as a reporting entity. And once if the taxpayer is regarded as a reporting entity, then it would be required to register itself with the Indian Tax Office and furnish all the details as may be required by the tax authorities. While it is important to note that as of now, they have not prescribed or they have not listed down the details that are required to be submitted, but this is an enabling provision which we believe is going to have a major impact and enhance major burden on the crypto exchange players. So this is a space that needs to be watched out. Usually the basis of this is that tax department wants to collect data not only about the exchanges but also of each and every individual taxpayers who are trading on the exchange and make sure that all adequate taxes have been paid by them in India. So all in all, I would say it's a welcome budget and it's a step in the right direction. Instead of innovating and making any major tax changes every year, FM is mainly, she has built a founding stone and she is building on it each and every year. We believe that the simplification that has been done in the past few years is also reflected in the new tax code which is likely to, which is going to be unveiled, and we look forward to any of these, any comments, or we'll be happy to answer any queries if you guys have. Thank you.